Hey everybody, my name is Justin. Thanks for joining me today. Today I want to talk about PayPal, ticker symbol PYPL. Here recently, they just hit their 52-week low. They were up over $300 a share, and now they're trading at below $200 a share. So I'm asking myself, is it the time to buy? So in this video, we're going to do a full stock analysis. I'm going to talk about the business overview. I'm going to talk about Moat. Do they have a competitive advantage over their competition? We're talking about management, who runs the company. We're going to do a financial overview, a 7-year trend on that. And then also I'm going to wrap it up and tell you guys my intrinsic valuation on this company, what I would expect to get for return on investment on today's stock price and potential future stock prices. So let's just jump right into this. And first off, let's take a look at a stock chart. And this is a 5-year chart. And you can see that it was all the way back at $38 a share in January 2017, hit its highs just a few months ago at $310. So you're talking a 376% return from $38 to today it's trading around $180. So even with this huge dip the last few months, they still have been well above where the S&P 500 is. So during that same amount of time, S&P 500 was around 120%. So pretty impressive. You've been a shareholder for that long. You've done quite well for yourself. So business overview. So here's kind of the PayPal route. So they started back in 1998, but it was originally called Confinity. They IPO'd in 2002 and was incorporated into eBay. Now PayPal spun off eBay in 2015. Now, PayPal is ranked 134th on the 2021 Fortune 500 largest U.S. companies by revenue. They provide electronic payment solutions to merchants and consumers with a focus on online transactions. The company had 377 million active accounts at the end of 2020, including 29 million merchant accounts. The company also owns, I think all this is called Xoom, Xoom, international money transfer business, and Venmo, which is huge here in the States, person-to-person payment platform. Recently, Amazon started allowing PayPal on its platform as well, which might really be kind of an underlying thing that the market isn't really looking at right now, and it could be some really nice revenue for them going into the future. All right, they're headquartered in San Jose, California. They're a $216 billion market cap. So that is massive. 26,000 employees, $24 billion in revenue over the last trailing 12 months. And their PE currently is around 44. So they're definitely trading at a premium compared to the market as of it is right now. So let's talk about Moat. What is the competitive advantage for PayPal? And I came up with one, and I think they have a network moat here. And what I mean by that is, that they really house everything into one space. Whether, say that you're going to go pay for something on, say you're on a platform and you're going to go pay instead of pulling out your credit card and just using that, whether it's MasterCard or Visa, PayPal will actually house all your different credit cards or payment methods there on that. And their platform is not only used on eBay, but used other places as well. In fact, you can even just use it from, consumer to consumer. If you're just buying stuff off Craigslist or Facebook, you could actually use PayPal as well too. I have in the past, and they do have some fraud preventions in place. You can use it on multiple platforms we talked about. Very easy to use, and it's a very, very sticky product. So once you know how to use it and you have your stuff in there, it's very easy to use it on other platforms, I personally think. All right, so management, Dan Schulman, and I gotta say, this is one of the most impressive CEOs that I have done research on just in general. And when I think of PayPal, I actually think of Elon Musk. So he's the one who kind of helped start the company, kind of get it going. But Dan Schulman has done an incredible job. So he's been the CEO of PayPal since September 2014. Dan previously served as group president at American Express before PayPal. He's the founding CEO of Virgin Mobile USA back in 2001. In 2021, Dan was ranked the third on Fortune's list of the world's greatest leaders. So that's really impressive. The New York Urban League presented Dan with the 2021 Frederick Douglass Award. And I got to say, he has a ton of awards that have been given to him even the last 2 years. So I couldn't list them all here, but it's very, very, very impressive. So he's obviously very well liked by the community, the people that he works with, and organizations. So very impressive overall. All right, so insider trading, what's kind of going on there? And over the last year, there's been 6 buys, 155 sells. So most sells, but a lot of the buys have been coming recently. So you can actually see David Dorman, who's a director, he did 5 purchases here just in the last about week and a half. So very interesting. And I guess the other purchase was back in November as well by John Donahoe, who's also a director. Now there's definitely been some sales going on, no doubt about it. But most of the buys, or actually all the buys, have been here recently. So that might be an indication, at least insiders think it's a good deal right now. All right, super investors. Do super investors own the stock? And several do, and they're actually decent sized positions in their portfolio. So Lindsay Train, 14% of his portfolio. Pat Dorsey, 12% of his portfolio. You got Terry Smith, David Rolfe. So there's a lot of people that do buy or have bought PayPal. And if you look even in the last quarter, I do got to say 4 out of the 6 were selling. 2 were adding. Now, it'll be interesting to see in this current quarter if people are buying into this stock or not. But definitely gives me a good conviction with all the super investors that have bought into them. So financial 7-year review here. We're going to look different growth metrics: sales, earnings, operating income, free cash flow, book value. We're going to look at management effectiveness, return on equity, return on invested capital, long-term debt payoff versus free cash flow. And also look at margins, gross profit margins, net profit margins, and operating profit margins. So let's jump right into that. First up is sales per share. And this is absolutely beautiful. Perfect linear trajectory up from $6 share back in 2014 to about 21 here in the last trailing 12 months. Now, earnings per share, close trajectory going 0.3 back in 2014 all the way up to about 4 trailing 12 months. So that looks really good. Free cash flow also going up a little bumpy, but going up 1.4 to about 4.2. So that's some good growth overall. Operating income per share also going up from 1 all the way to about 3.5. So this is really, really nice growth that we're seeing. Book value per share, this is also fantastic, about 6.7 up to 18. So out of all 4 of these metrics, I mean, this is almost perfect on how you want to lay out a business on what you want to see. So very, very impressive. Now, long-term debt payoff, this looks really good. So they've had actually no long-term debt for a long time. Here recently, it looks like they picked up some debt. I did not dig into it to see if this is capital leases versus actual long-term debt. So, with the recent changes actually back in 2019, this could be capital leases. I'm not sure off the top of my head, but either way, they're in really, really good shape. I mean, I want to see at least 3 years or under 3 years to be able to pay off their long-term debt versus free cash flow. And right now it's about 1.5. So it looks really, really solid. Working capital, so this is current assets minus current liabilities. I want to see positive, and hopefully growing, and we see that. I mean, this is very, very good. So 4.2 billion all the way up to 12.4 billion. So they certainly have a lot of current assets on their books versus current liabilities. That is great. Return on invested capital, return on equity. This kind of gives me a good idea how well management takes money from shareholders and also debt financing and turns it into net income. I want to see at least a 10% per year. And man, not only is it 10% per year most years, it's actually going up. So ROIC from 4% to 16, ROIC 5% to 22%. That looks really, really good. Next up is gross profit margins. This one's actually going down. So this is really the one metric that I looked at that did not look good. So gross profit margins kind of the top side of the P&L. You're looking at direct costs versus total revenue, and it is going down from 53% to 48%. Now, operating profit margins pretty much even. I mean, 16 to 17%. There, but net profit margins are going up, very similar to what we saw for EPS from 5% to 20%. All right. So if we took a look at the 8 key metrics here, first up, we'll take a look at growth metrics. And so I want to see at least a 10% growth per year on each one of these. So sales, for example, is 18% growth per year over the last 7 years. Earnings per share, 27%. Operating income, 20%. Free cash flow, 19%. Book value, 9%. So only one that was actually under 10% was book value, but all the rest of these right here are all yeses. So and beating it quite a bit. So that looks really good. Now, return on equity average is 14%. ROIC is 12%. So those are yeses as well. And then yes for debt payoff as well, because it's less than 3 years. It's 1.6 years to pay off their long-term debt. So the only one that's a no is a book value, but it's barely off. It's still pretty darn close to 10%. So fantastic. So all these are looking really good at, and the only other company I could think of that had this type of growth that I saw recently was Facebook and also Nintendo. So this is very, very impressive. All right, so shares outstanding going down from about 1.2 billion down to about 1.1 billion. And actually, if you think about book value, so it really should be a yes for book value, because if they're buying back shares, that's actually reducing their equity, which is actually reducing their book value. So if it wasn't for that, their book value would be well over 10%. So pretty impressive overall there. Dividends, they don't pay any dividends, so we're just going to skip that. Now, as far as valuation goes for this company, we're looking at a couple trends. P trend, acquires multiple, a couple different intrinsic value methods, earnings per share, payback time, and then discounted free cash flow. So first up, let's take a look at the PE trend for this company. So they were back around 32-ish back in 2015. That's when they IPO'd. So usually I like to go back 7 or 8 years on this. We can only go back about 6 years or so. Because that's when they IPO'd. And then it got all the way up to around 80 back in 2020. So not long ago. And then now they're trading around 44, which we saw at the beginning of this video. So from this standpoint, historically, it looks like it might be a decent value compared to where they have been in the past. Now, acquires multiple trend. This is looking at enterprise value over EBIT. And it was about 22 low. It got all the way up to about 80. That's really high. Right now it's trading around a 50. So it doesn't look necessarily expensive looking at this, but it doesn't look great either. Just in general, a stock that I would consider of really great value would be, somewhere under 5. But, obviously PayPal, it's a huge growing company, so people are willing to pay a higher premium for it. So that's what we're kind of seeing higher numbers here. So as far as a P and acquires multiple, potentially could be a buy based on those trends historically, but not screaming deal by any means. Now, let's talk about expected ROI. So in order to do this, we're going to jump over to my spreadsheet, and we're going to take a look at a couple different valuations on calculating intrinsic value. So let's go do that now. All right, so first up, let's talk about earnings per share. And what this model does is takes earnings per share, it projects it out on the growth rate that I come up with to try to get a future earnings per share. And then based on what rate of return I'm looking for, is going to discount that back to get to a current sticker price. And then we'll kind of compare that against what the sticker price is on the market right now. So as far as earnings per share, first I kind of look at trailing 12 months. That's 4.2. Now, I do feel that the earnings per share is inflated slightly for 2020 and 2021 based on a gain of investments that they had on their P&L. So I'm going to reduce that just slightly. I'm going to use a 4 for that. And now as far as growth rate goes, so analysts think right now it's going to grow 20% per year over the next 5 years. Now, if we go and take a look at my summary spreadsheet here, this will kind of give us another idea of kind of where they've been historically. And this is kind of what we went over in my presentation here earlier. And if you see this line right here, this is the earnings per share. So it actually have grown 27% per year over the last 7 years. Very, very impressive. Analysts think around 20%. So for my evaluations, I always like to be conservative, especially since this company has been growing so much as they get bigger and bigger. I mean, you're talking a $200 billion market cap. It's going to be harder for them to grow at that, same type of level. So for my growth rate, I'm going to be using an 18%. on that. So 18% here. So based on that, I think earnings per share 10 years down the road should be around 21. Future stock price around 523. So based on a 10% rate of return, I get a current sticker price of $201. And today it's trading at $184. So about a 10% margin of safety. Not much there, but there is a little bit. Next up, let's take a look at payback time. This is one that I've been starting to use here recently. Essentially, is when I put money into a company, how many years is it going to take to get my money back on that? And I'm looking really at 8 years or less. That's optimal for me. And the reason for that, historically, people are willing to buy companies at a 16 PE on average across all industry segments of the market. And so if I'm looking to get paid back in, say, 8 years, essentially I'm trying to get almost, even though this is free cash flow, I understand that it's kind of like getting my money back twice as fast as what the market is expecting from a historical overwide view of the market. So it's actually coming at 13. Actually, it's more than that because I kind of just stop at 13 on my projection right here. So that does not look very good. So basically, I'm looking at an 18% growth rate, about $5 billion of free cash flow, which was here the trailing 12 months. So it would take over 13 years to get my money back. So that does not look very good from this standpoint here. Next up, let's take a look at a discounted free cash flow model. And essentially what I'm trying to do here is project out about 18% growth rate and then discount it back today. I am using a P of 18 because that's similar to what my growth rate is. You could use one that's higher than that, I guess, for PayPal. For me personally, I tend to use between 10 and 20. And keep in mind, this is like a 10-year type of projection. So in 10 years, what do I think the P is going to be worth? So 18, I don't want to go higher than that personally. Certainly, if you feel that it's going to be that way, then that's kind of how you value it. That's how I'm looking at this. So based on that and 10% return on investment, it would be $195, which is only a 6% margin of safety. So, earnings per share was about that 10% margin of safety. Payback time did not look good, and then intrinsic value for discounted free cash flow model only about a 6% margin of safety. So let's jump back on my presentation. We'll talk about what I think the return on investment will be for this company going forward. All right, so back on my presentation, and like I say in every other video, what I'm going to show you does not guarantee any kind of future performance. This is just how I'm looking at PayPal. Every investor should be doing their own valuation and evaluation of a company. And this does not factor in buybacks, does not factor in dividends at all. And PayPal doesn't do a dividend anyway. But here is what we're looking at, and let me explain what this is. So if I think the stock price was, is $200 a share, I would expect a 10% return. If it was $130 a share, I'd expect 15% and so on. So right now it's trading around $180 a share. So it's kind of in this place here. So it's actually around 10, 11%, just kind of around there. So pretty close to the market overall. So if you're looking at this, a year from now and the stock is trading at $55, that would look pretty good. I would estimate around 25% return on investment for this company based on that. So that's how I'm looking at what return on investment for this company. Now, as far as a summary of this stock analysis that I did, so let's first talk about the good. They do have a strong moat. I think they have a very strong networking moat. I think their product is very sticky. Here recently, even Amazon is now using or allowing to use PayPal, which actually may generate some more revenue for PayPal. Well, so that's pretty good. Strong growth, sales and earnings specifically look very, very good. Overall, strong financials. I mean, they have really good working capital, low debt, very, very well-run company. I didn't talk about acquisitions in this video, but if you look at their acquisitions, they have a ton. I mean, you're talking 25, 30 different acquisitions that they've made over time. And it seems like they've done a really, really good job with those, integrating those into the company, into their culture, and it has just generated more growth. So they've done an excellent job there. Now, as far as a bag goes, there's a lot of competition in their space, and it keeps growing. So you got Square, you got Apple Pay, Stripe, all the credit cards, Visa, MasterCard, etc. So PayPal has done a very, very good job, not fending off competition, but really growing more than their competition. But certainly competition is there. Now, one concerning thing is their free cash flow does lag their earnings. I do think the 2020, 2021 earnings that we're seeing were slightly inflated because some gain on investments that they had sold that I saw on their P&L then actually flowed through to their cash flow statement. So that's a bit concerning to me because if I'm looking at earnings per share basis, the company looks decent from a valuation, but free cash flow, it does not look like it's a great value. It's trading at a premium to market, always has traded at a premium to market. So there's a lot of growth factored into today's stock price. So if they were to slow down in their growth, the stock could really take a hit. So it's just something to be aware of. And the return on investment that I'm projecting for this company is not all that impressive. So as far as stock grade goes, thumbs up, better than market, thumbs sideways, even with the market, thumbs down, less than the market. I'm going to give a thumb sideways just because I think it's going to be pretty close, even with the market. Again, going back to the theory that this company is already a $200 billion market cap, it's going to be harder to grow going out into the future. But at the same time, I think they have an excellent CEO, one of the best CEOs I've seen. So he's done a really great job with acquisitions, trying to drum up different ways to bring in revenue. Example is that the Amazon partnership they just did. So could they end up being the market? Certainly they could. I think it's going to be very difficult for them to, based on where they are right now. But I gotta say, this is definitely a company that is on my watch list right now. This would be a company I would love to own. I do think they have a very, very strong moat. And I do think they're still going to grow at a decent rate going in the future. It just looks like their valuation is very rich, even with the pullback here recently overall. So thank you so much for watching. I really appreciate it. If you got some value out of this video, please like the video. Helps out the channel a lot. Helps out this video, pushes out to more people. I personally appreciate it. If you like this kind of content, I encourage you to subscribe to my channel. And some future videos I'm looking to do another update on Alibaba. We're going to do a stock analysis on Ford, Google, Victoria's Secret, Huntington Eagles, Oracle, Alight, and Boston Beer. And if there is a stock you want me to dig into, throw it down in the comment section. I read those all the time. You never know, I might grab one of those. Thanks again for watching. I'll catch you guys on the other side. Take care and God bless.